Did you know that missing out on just a few of the best trading days in the stock market has the potential to absolutely destroy your annual returns? According to finance guru Tony Robbins, the average annual return of the stock market is about 8.2%. But if you miss out on the 20 best trading days, your annual return will sink from 8.2% to a measly 2% over the span of 20 or so years. If you're unfortunate enough to miss the 30 best trading days over a 20-year span, then there's a good chance that your returns could even be negative. This statistic was uncovered in a study conducted by J.P. Morgan and Charles Schwab. Basically, what it means is that there are a few days throughout the year where the stock market experiences very oversized gains. If you don't have money invested during these days, then you'll miss out on most of the growth for that year. For example, in 2020, from the 5 days during November 2nd to November 6th, the market jumped over 6%. Considering that the average annual return of the market is about 8%, this is almost a year's worth of returns in just 5 trading days. Luckily, I've come up with 3 strategies that you can use to make sure that you never miss out on the best days in the stock market. Grab a pen and paper because you'll definitely want to write this down and keep them handy. While you're at it, you'll also want to subscribe below and click the bell notification so that you'll be alerted when we drop any time-sensitive investing advice. Now, let's take 3 strategies to help you maximize your investment returns. One of the hardest parts of stock market investing is being able to ignore the daily fluctuations in stock prices. The more money you have invested, the harder this gets. The reason that this is so difficult is that there will be plenty of days where you have to watch your account lose hundreds or even thousands of dollars at once without panicking. As you might imagine, this goes against human nature. It's a little bit like how you're supposed to stand your ground when there's a bear running toward you in the wild. If you turn and run, then the bear will catch you and maul you. But if you stand your ground, then the bear will stop charging and respect you. You need to override your primal instinct and do what you know is the smarter strategy. The same is true in the stock market. When the whole market is going down, you need to do your best to stand your ground and not sell. Ironically, markets that are trending downwards are called bear markets, which should serve as a good reminder for this strategy. To highlight how this works, let's take a look at a 5-day graph of the stock market. Right away, it's easy to see how the stock market moves up and down in big swings. It's common for the market to move in the same direction for days at a time. For example, let's say that the market dips 10% over the course of a few days. This would bring the value of a $100,000 portfolio down to $90,000. $10,000 is a lot of money to lose in a few days, and all of your instincts will tell you to panic and sell so that you don't lose even more money. But if you look at the longer trend of the market, it pretty much always recovers from any dips. This is why strategy number 1 is to just leave your money invested in the market. It's really that simple. By doing less with your investments, you actually have a better chance to make money over the long run. Otherwise, you'll constantly be buying more stock when the market is at its highest point and selling stocks when the market hits the bottom. This is a foolproof way to kill your stock market returns. Instead, what you want to do is buy more when the market is at its lowest point and then sell off some of your gains when the market reaches its peak. Our second strategy is a little similar to this strategy number 1. Let's get into strategy number 2. But before we do, be sure to hit that like button if you've already learned something valuable in this video. There's a famous quote that goes, "More money has been lost trying to predict stock market corrections than in the corrections themselves." This expression means that it's very common for people to get spooked and pull their money out of the stock market. When this happens, they end up losing out on any gains that the stock market experiences while they're sitting on the sidelines. Part of the reason why people get spooked is because of the media. Have you ever heard the phrase, "If it bleeds, it leads," when talking about the news? What about "fear sells"? If not, both of these phrases are commonly used when referring to the media and things that they choose to print. In general, people are more likely to read stories that are scary or strike fear in society. Since these types of stories generate more clicks and higher readership, media companies are more likely to run them. This is part of the reason why the news always seems to be so negative. This is especially true for the financial news. Regardless of when you're watching this video, I'm challenging you to Google stock market crash right now. I bet that you'll get tons of results that are all raving about the impending doom that's right around the corner. Go Google it. See if I'm right. Just be sure you come back after, okay? All right. If you didn't feel like Googling it, here's a picture of what my search results pulled up on the day that this video was made. You can see that there are plenty of articles that are ranting and raving about an upcoming crash. The biggest problem is that the media is churning out articles like this almost every day since the dawn of time. If you listen to every doom and gloom article that you read, then you would never invest any money at all. Now, I don't want to mislead you because the stock market definitely crashes from time to time. Most notably, there was the dot-com crash in the early 2000s, the 2008 financial crisis, and the pandemic panic of 2020. During the dot-com crash, stocks lost about 40% of their value. In the 2008 crisis, stocks lost about 50% of their value. And in the pandemic panic, the stock market tanked about 30%. These were all significant downturns. However, it's important to keep in mind that these crashes all happened decades apart. In between these crashes, there were long stretches where the stock market rallied. For example, during the 2008 crisis, stocks crashed by 40%. But in the decade that followed, they rallied by over 250%. I'm willing to bet that if you could check out news articles during the years 2009 to 2020, it would be filled with articles that anticipated a crash in the near future. All of these articles were wrong because the market experienced one of the longest bull runs in history. The smart investors simply kept their money invested this whole time, while scared investors kept selling, waiting, and then buying back in. To use a more modern phrase, diamond hand investors make the real money, while paper hand investors get crushed. This brings us to strategy number 3. Keeping a stockpile of cash at the ready is one of the most important things that you can do from a general financial perspective. Unsurprisingly, it's also a great strategy for making sure that you never miss the best days in the market. Let's examine the 2 biggest reasons why. First, almost every financial guru in the world will preach the importance of having an emergency fund. An emergency fund is a small sum of money that you keep on hand in case of, wait for it, emergencies. Life is full of surprises, and you never know when you might need a few $100 to pay for something that you weren't expecting. That said, it is also a little bit of a waste to just have money sitting in a bank account waiting for an emergency that might never come. Instead, you should think of your emergency fund as your cash reserves that you can use in case the market dips. Nobody is ever expecting the stock market to crash. Well, except for the media, I guess. But expecting the stock market to crash and the stock market actually crashing are 2 very different things. When the market is actually tanking for real, you will definitely want to make sure that you have some cash on hand. Having cash available when the market crashes will prevent you from wanting to sell your stocks at a low price. It will also give you the option to buy even more stocks while the market is tanking. I know I might sound like a madman for suggesting that you should buy more stocks when the market is tanking, but hear me out. On Black Friday, stores have huge discounts on their goods and people trample each other to try and save money. In the stock market, when the market tanks, it's really just a sale for stocks. Most of these stocks are still very good businesses, and a stock market decline gives you the opportunity to scoop up these stocks at a discount. Making sure that you have a stockpile of cash on hand can give you the confidence necessary to keep the bulk of your money invested long term. Then, if the market actually does dip, you'll be prepared to buy more stocks at a discount. By doing this, you'll practically guarantee that you never miss the best days in the stock market. If you found this video valuable, please be sure to follow the very first link in the video description below and subscribe to my newsletter. By subscribing, you'll receive my most valuable tips for investing, any potential stock picks that I come across, and more informative content similar to what you've just watched. Most importantly, I don't believe in sending automated emails or spamming my subscribers. Instead, you can trust that each email that I send will be filled to the brim with valuable information that's sure to make you a better investor. Thank you so much for watching. I appreciate it, and we'll see you next time.